Let's talk about really bad inflation or really bad stagflation in the Chinese economy, and also how the Chinese economy, there's been a lot of very interesting things happening in terms of bad central planning, in terms of structural changes to China's real economy in just the last 5 or 6 months. So the producer price index numbers that have come out lately out of China have the official numbers for cost increases for Chinese manufacturing are 13.5%. However, from speaking with anecdotal sources and also seeing a number of interviews from a lot of Chinese business owners on the China Insights YouTube channel, and there's been a lot of videos coming out on the China Insights YouTube channel over the last month or two talking about rapidly rising costs for Chinese manufacturers, especially for electricity costs. There are legitimate energy problems, shortages of electricity. Chinese government agencies have officially ordered Chinese people to stockpile food and energy, anticipating continued problems. The cost of electricity, the cost of energy in China, especially for manufacturers, is going sky high. There's been a ton of stories really since November 2020. That's when the problem started to leak out, and they were called a lie and propaganda at the time in November 2020 when the problem started to come out about how desperate China was for coal, about the shortages, about how the Chinese government was shutting down factories because there was legitimate energy and electricity shortages. So the costs of food, of vegetables, of energy and inputs, the official numbers are seeing double-digit cost increases. However, anecdotally, from speaking with other sources in China and mainland cities, the costs are way above the 13.5 producer price index number on a lot of different items. So that's just the official number according to Stagflate Tax Lie. However, that is just the official number that the Chinese government is admitting to. And China is still manufacturing a lot of goods that are exported to the United States, to the European Union, to many other areas. So if the cost of manufacturing, if the costs are still rising in China, if they're still rapidly rising and going up, or Chinese manufacturers are not making nearly as many goods as in the past, this is going to create continued amounts of inflation and stagflation in many different items throughout global supply chains, and also that a lot of governments are going to have to, especially the United States government, because of Stagflate Tax Lie, they will want to take the rising inflation. They will come up with more and more ways, and I highlighted this in a video in the last couple weeks, to remove higher consumer price data, even though that's not how Austrian School of Economics measures inflation, but that's how the official inflation statistics are measured. The PhD economists inside the Bureau of Labor Statistics and at the Federal Reserve will still come up with new ways to slow down the official inflation rate. There's a lot of incentives for why the governments, all these different governments, want to cheat. Now, I want to talk about big structural changes happening in China. They've really started over the summer. A large chunk of this has to do with how Chinese real estate prices are falling. So Chinese real estate prices, and in many major cities now, and this is the first time this has happened in a very long time, we now have 3 or 4 consecutive months of real estate prices falling rapidly or crashing. There's a lot of anecdotal stories in suburbs outside of the tier 1 and tier 2 cities of people being upside down in their mortgages. So that's a big red flag, very similar to the United States housing crisis. And also the average retail Chinese investor has limited investment options. China has very strict capital controls, very draconian capital controls that actually get worse every couple years. And the investment options for a lot of Chinese retail investors, because real estate prices are falling, because there's a cryptocurrency ban for regular Chinese people, not for Chinese Communist Party elites or Chinese billionaires, but for regular Chinese people, a lot of the savings, a lot of the investment demand, because there are still healthy portions of the Chinese economy, a lot of that savings, a lot of those currency units are now going into physical gold, physical silver, and physical platinum. Whereas in the past, they would have been invested into Chinese real estate, they would have been invested into cryptocurrency, or there would have been a high fee paid to launder savings out of the country. That is becoming more and more difficult. So there's less investment options for the average Chinese person, and that is creating demand for physical gold, physical silver, and physical platinum inside mainland China. But the structural problems that I wanted to talk about in mainland China, A lot of it is because of bad central planning. So the Chinese government over the summer, they banned private education companies. So all these private education companies are either shutting down immediately or they're going to be shut down in the next 6 months. They're rapidly firing 30% of their workforce. There's videos on China Insights on their YouTube channel. It's a large YouTube channel, China Insights, that talk about this. Also, and I'll attach a link in the information and description section if you want to watch the video. Also, other industries in China are going through very large scale changes. A lot of this is because the Chinese government is doing bad central planning. They've done bad central planning with wasted misallocation of capital, trillions of misallocated capital on bad infrastructure projects. I highlighted one of those on the right-hand side of your screen. That video is also from China Insights. It is about the high-speed rail in China being totally uneconomic and also about the real estate crisis in China. And then you also have other industries in China, like the big technology companies in China. There's a lot of press releases coming out over the last couple months, how by January or February, a lot of larger Chinese firms will be firing 30% of their workforce. This is still creating stagflation because the People's Bank of China, China's central bank, is still trying to print money. They're still trying to bail out Chinese banks. They're still trying to prevent or at least slow down real estate prices in mainland China from falling. So you have a lot of firms in mainland China, whether that's technology, whether that is private education, which is being shut down by the government, whether that is travel and tourism because of the pandemic, because the Chinese economy is slowing down. You have these major industries that used to be big growth engines for the Chinese economy. They're shutting down. Now, this will not stop. It may slow down a little bit, but it will not fully stop stagflation, because to counter this, and this is what Austrian school economists Ludwig von Mises and others have said, inflation is 100% government created. It's created by bad policy, by politicians and central bankers messing around with the money supply and credit, and also with distortions of politicians, bureaucrats trying to raise wages, force wages higher. So you have an enormous amount of bad policy and very serious structural changes and paradigm shifts that have started in China over the last 5 or 6 months. And this is all making a mess of things in terms of Chinese manufacturing and the cost of goods sold. So even if there is wide-scale firings in China, so this is not going to allow China to export deflation as they have done in the past with some of their manufacturing. The cost of goods sold for a lot of input costs in China are still very high and still rising. I do not see any short-term solutions for China being able to drastically lower their electricity costs. China needs to switch away from coal, from these coal-fired power plants. They need to switch to nuclear power. They need to switch these coal-fired power plants. They can do it relatively quickly and relatively inexpensively. They can import more liquefied natural gas and natural gas. That would be better for the environment too. But that would mean substantially higher natural gas prices over the long term. Over the next 10, 15, 20 years, we would have a new price floor for natural gas then, if China were to switch a lot of its coal-fired power plants over to natural gas. Finally, if you like content like this, I want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content, research, financial education, and analysis than I provide in these short little free videos, there are now over 190 articles and audio podcasts behind the paywall, including 36 new articles and audio podcasts out in the last 25 or so weeks, and that also includes 6 new audio podcasts out in the last month on a lot of interesting topics about global macro companies and sectors. I'm going to try to get a couple audio podcasts out exclusive for patrons out in the next week or so. Been taking a little time off because of the holidays, also my health problems. I'm not feeling too well, but that's not going to go away anytime soon, unfortunately. And all this content is only $5 a month, the cost of a Starbucks cup of coffee, exclusive for patrons behind the paywall. I think it is one of the best deals out there, so please check that out. So if I could wrap up this short little video very quickly, there are big changes happening over the last 6 months to the Chinese economy. The People's Bank of China is still printing currency and credit. There's been new liquidity injections announced in the last couple weeks. The reserve requirement ratio was lowered for the Chinese banks. So far, we have not had any major Chinese state-owned enterprise banks fail. There is really bad stagflation in mainland China. The official numbers in the producer price index are 13.5%, the last one that I saw come out. That is not the real number. If you go and watch these YouTube videos on China Insights over the last couple months, interviewing factory owners, they're talking about their electricity costs are up 10x or more over the last year or two. Just insane. Other input costs are also up. So the costs that are rising the fastest in China are food and energy. The Chinese government has also told people in China to stockpile food and energy in case of an emergency. So you have that too. So you have emergency stockpiling too. That is creating even more demand. And because costs for manufacturing in China are rising, because factories are not being allowed to produce as they normally would because of the electricity shortages, and the Chinese government is not giving Chinese factories the priority for electricity, you are going to have shortages. You are going to have rising costs being exported out of China. This is the first time in decades that this is basically the case. This was not the case in past financial crises. This was not the case as China was industrializing. The narrative out there that Wall Street loves to repeat is that China exports deflation. I think that this is clearly no longer the case, especially with the policy that the Chinese government and the People's Bank of China are continuing to do now. We have not had any major Chinese state-owned enterprise bank failures. The Chinese government has decided to allow Evergrande to declare bankruptcy on foreign bondholders and offshore dollar bonds. We're probably going to continue to see waves of defaults from other Chinese real estate developers. I would watch to see if any Chinese state-owned enterprise banks fail. If China does continue to have major problems in their economy, I think rather than China's currency, the yuan or RMB, I think the base metal prices would be the first ones to be affected. Although in the long term, there are still shortage problems and the cost to bring on new base metal mines because of all the inflation that's been put in the system globally by all these central banks and governments the last 20 or so months is so enormous. The new cost to build a mine is up between 25 and 60% across the board pretty much. So the Chinese economy, despite how there's either already been wide-scale firings or there's going to be mass-scale layoffs over the next couple months, either they've already started or more of them were pre-announced to come in January and February, there's still bad stagflation in China that's been created by their government and by their central bank. And by bad policy, bad central planning policy by their bureaucrats, by their politicians and bureaucrats. And as long as that continues, it's going to be very tough for consumers in other countries to get beneficial deflation.